Hello guys and welcome again to my channel. So let's talk about accounting. So actually this is designed to be an introductory video for my series. So from zero to accounting hero, something like that. So I am assuming that the viewers of this video do not have any knowledge yet about accounting, and supposedly if the series will be finished, if ever, it's still construction in progress. But if it is finished, then from zero the viewers will become accounting heroes, something like that. So basically, let's talk about first accounting. Okay, so accounting has a lot of definition, but first I would like to, what do you call this, to shatter any misconceptions, famous misconceptions about us. So as accountants, although our job is a little bit like a mystery to others, unlike other professionals like doctors of medicine, we all know how doctors of medicine works, right? What is their purpose? The nurses, what are their purpose? And any other architects, engineers, we know what they are doing, right? But as accountants, it's a little bit mysterious in a lot of ways. Okay, so I think I could not hear little children that will say, when I grow up, I wanted to be an accountant, something like that. I wanted to be a doctor, architect, something like that. Is present, but when I grow up, I want to be an accountant. That's seldom. So, what are these misconceptions? Number one, we are mathematicians. We are not. Okay, so we do not have complex equations that we are using here. We have A is equal to L plus C. Although I believe that we are also doing some maths, like for example, algebra, we need to have that, the skill on the algebra, as well as on statistics. Basically, aside from statistics, I guess we need to have the knowledge on time value of money, the present value of one, and etc. Other than that, there are no mathematics involved. There are no complicated equations. And sometimes, we are actually using calculators most of the time. Not sometimes, most of the time. We are very dependent on calculators. So, again, we're not mathematicians. We're, of course, analysts. We're using logic, we're using standards in our work, just like lawyers are using the law. We have standards, okay? So, next misconception is all about we are working in the bank. We're not working in the bank only. Actually, there are a lot of fields that we can work into. Like, for example, me, I am a practitioner in a school. So I'm teaching major subjects related to the CPA licensure examination. So I am in Academe. Okay? So sorry, I'm a little bit sweaty. So I'm in Academe. Okay? Now, aside from being in the Academe, you could also be in the government, um, being a government accountant or auditor, or something like that. And aside from the government, you can also be in public practice, whereby you make your own office, just like a notary public, and that your customers are anyone in the public. And you could also be in the commerce and industry, corporate positions like controller, chief financial officer, and something like that. So we are actually found everywhere. I don't know if it is, what do you call this, if it is 100% true, but we're everywhere. Okay? So accountants are not only in the banks. And the third one is that whenever there are someone who encourages you have to be an accountant because one signature, big bucks. That's not true. We are affixing our signature after a rigorous work. Like for example, when we do our audit, of course, we are going to make an audit report and affix our signature. So we are affixing signature. The client shall pay us. It could be big bucks. It could be not. However, the point is rigorous work happened first before the signature, before the payment. Okay? So again, we are following standards and we have to follow those standards in our work, in auditing, in accounting, and etc. Okay? So those are the misconceptions. Now, let's talk about accounting. So accounting has a lot of definition. We'll go through it, but I would like to tell you, I did not memorize the definition word by word. I just have the keywords, okay? So the first one is from the Accounting Standards Council. Accounting, this is just a shortcut, Accounting Standards Council. So the Accounting Standards Council is a council here in the Philippines in the past, because this is now non-existent. In the past, that is in charge with, what do you call this? Um, the standards that needs to be followed by the practice here in our country, Philippines. So if there are standards, they are the ones who reviews it. Sometimes they make amendments. Sometimes they are changing some things, making amendments or changing some things. That's the same. In order to make it logical and effective in the business environment here in the Philippines. So that's Accounting Standards Council. Again, this is non-existent already. We have our new council that will check the standards. They are known to be the Financial Reporting Standards Council. Financial Reporting Standards Council. Okay? Now, um, my point is you should have a knowledge first about this one, so that you will appreciate also the definition that they give. But the purpose is really on the definition. So the definition of Accounting Standards Council goes like this. Accounting is a service activity. Okay, that's self-explanatory. Its function is to provide its function is to provide quantitative information. So it's a service activity, the accounting. And then it's all about providing numbers, quantitative information, primarily financial in nature. So it's all about money, mostly money, to permit informed judgments by the users of information, so that there will be basis on the judgments that will be made by the users of financial information. It's not just subjective, it's objective. Okay? So meaning it's a service activity. Again, it's a service activity providing quantitative information, primarily financial in nature, in order to help the users of information make informed judgments and not subjective. Okay? Now, actually, basically, the endpoint, as if one of the endpoints, I'll say one of the endpoints, because actually, the endpoint of accounting is not the making of the financial statements only. It's interpreting what's in the financial statements and communicating it to the users. Okay? But in this particular, since we are still starting, our endpoint is supposedly making of financial statements. Okay? So, actually, the financial statements and its information are needed by different parties, known as the users of FS information. So the users of FS information are making decisions. Okay? And those decisions should be based on the financial statement information or accounting information. So who are these users? We have G-clips. G-clips, so that you can memorize it immediately. We have the government. We have the employees. We have the customers. We have the lenders. We have the investors. We have the public. We have the suppliers. No. Supposedly, there is only one E. So let's transfer the employees here in the end. So this is not just about accounting. I'm also giving you ideas on how you can manage to remember a large amount of information. And sometimes I do that like this. It's a mnemonic so that I could remember them. It's like organizing memories in the cabinet on my mind. So this is the cabinet, and these are the contents. Okay, so these particular users of information have different what do you call this? Information needs. Like the government wanted to know if ever, for example, if you're working as an accountant of a big corporation, so that big corporation can already affect the economy. So the government will be interested if ever your business is doing well. Because if it will not be, if it is not doing well, it will affect the economy. Aside from, of course, taxes. So these users have different needs, information needs. So we have the customers also. They wanted to know if the company is doing well, trustworthy, and sometimes when they decide to consume products, they are choosing the trustworthy companies. Okay? So those are the customers. And later we have the lenders and the investors. Let's go first with the public. So the public are potential investors actually. So the general public will really need to know if ever your company is doing well because maybe they could invest in such company, use the company's products, and of course, again, it will affect sometimes if we're talking about big companies, it will already affect their lives. Like, for example, if we're talking about utility companies, so the general public will be very much interested in you if you are a utility company because you already affect their everyday lives, something like that. And we have employees. So employees wanted to know if their company is struggling or not. Okay? Because sometimes the employees, if they wanted to go out already of the company and find greener pastures, they have to know if their company is doing well, is sustainable or not. Sometimes also, the employees wanted to know if it is struggling or not so that they could change. They could help the struggling company, something like that. So I am discussing first those users that are for me are secondary users because according to the standards that you will know later on or the conceptual framework, there are main or primary users of information. We have this one, the lenders, the investors, and the suppliers. Actually, lenders and suppliers are actually grouped into one. They are called creditors. So the main users of information of the company are of course the owners or the investors. They wanted to know if ever the company is doing well, profitability. Of course, their wealth also. They wanted to know if ever it had grown, okay, by investing in that company. So investors actually need a lot of information aside from profitability. They wanted to know the company if it is liquid or it has a lot of cash. Liquidity, that means the company will be able to discharge its currently maturing obligations, something like that. So generally, the investors need a lot of information for their decision making. Will they continue investing or will they sell the company or sell their ownership if ever? Or they have to do something because the company is dying, something like that. So that's the first. For me, this is the top one of the users of information. And we have the lenders and the suppliers, collectively known as creditors. So these creditors wanted to know the profitability, of course, of the company and the liquidity also. Because they wanted to know if the company will be able to meet its obligations to them as creditors. Okay? So basically, these lenders, investors, and suppliers are the main reason sometimes that the standards are designed nowadays. So the providing of information is centered on them. You have to remember that in if we're going to talk about higher accounting standards already. They are the main characters. Okay? So, of course, they have to make the right decision, which is why they need to rely on FS information. So, that's it for Accounting Standards Council. There are users who need to make informed judgments. So, financial information is given to them as a service by the accountants. Okay? So, that's it. Now, let's go to the next definition. The next definition is from the American Accounting Association, which is actually the oldest definition, in which accounting is the process. The keyword is process. That means it's a step-by-step process. Okay? It's a process of identifying first, measuring, and summarizing, communicating, IMC. Financial information. Okay? Identifying, measuring transactions, and communicating the financial statement information to, again, users of information. So, what's new in here? We have the identifying and the measuring. So, accounting actually starts with business transactions. Okay? So, what happens in the business are considered as business transactions. The selling, the buying, the incurring of expenses, those are business transactions. But not all of those are considered accountable. So, which is why we have to identify those um, transactions that are accountable and that should form part of the financial statements. Okay? So, that's the process of identifying. So, what are the criteria usually so that the accountable transaction can be identified from the general business transactions? So, there are two criteria actually. The first one, it will affect the assets equals liabilities plus capital. So if the transaction affects this and they are measurable, they are to be considered as accountable transaction. So when we talk about A is equal to L plus C, this is actually the accounting equation. So you have to think that this is the business itself. When you are studying accounting, your point of view is of the business itself. As an accountant, as if you are the business. And this is you. Okay? The assets equals liabilities plus capital because businesses are intangible. So this is as if you, and if there are some things that happened that affected you, your assets, your liabilities, and capital, that will be accountable. Okay? Second is it should be measurable. So that's the process of identifying. So in order to what do you call this? Know the basics of the assets equals liabilities and capital. Let's define this simply. These elements of the accounting equation. So actually assets are the resources controlled by the entity. Okay? I guess I have erased my blackboard using my t-shirt. But it's okay. So identifying, again, we have assets, liabilities, and capital. If the transaction affects this, it will be accountable. The assets are the resources controlled by the entity, or what do we call as resources? It's self-explanatory. Like when you are buying a building, that's your asset. Okay, so the businesses has that also. We as humans can own assets. The business can also have assets. The building, the land, and etc. Those are resources of the business. Assets again. Assets are resources or economic resources controlled by the entity. Control, that means the benefits of those assets are being enjoyed by the company itself, aside from the benefits, they have the power to direct the use, of course, of the assets. Okay? So meaning, you don't need actually to own the assets. You just have to control the economic benefits. You can consider that one as your asset already. Like for example, if you have rented a certain equipment, that equipment, if you are the ones controlling the use, as well as you are the ones who will enjoy the benefits, and also you are the ones absorbing the risk of having that equipment, you could already identify that as your asset. Not equipment, but right of use, for example. But even if, uh, but even if you control those assets, you are not the legal owner. Still, you can recognize that here as the assets. Liabilities are the obligations of the company to third parties. Like for example, if the company avails a loan from banks, so those are here in the liabilities. And as to the capital, that is, I guess, so that you will understand, this is the obligation of the business to its owners. Okay? So you imagine that these are just the list of resources, list of obligation to third parties, and list of obligation or amounts pertaining to obligations to the owners so that it will be easier. Okay? So actually, there are always two effects at least whenever there is an accountable transaction. Like for example, if the business owner invested 1 million of its personal funds, it will go here, 1 million on the capital and 1 million right here. So we're talking about now a double entry. So this equation should always be balanced. So if there is an accountable transaction that is measurable, that is an example of what will happen. There are dual entries. Okay? So if ever you can already see something in the business if there are amounts already. You can say that the resources of the company comes from the owners of the business, something like that. And if this is liquidated, these assets will be given to the owners. There are a lot of information that you can get from this already. Okay? So I am introducing to you the accounting equation already, aside from letting you know what identifying means. Okay? And of course, it should be measurable in money. Okay? So sometimes, even if there are resources of the business, but since it could not be measured uh, in monetary, what do you call this? In money, to be simple. Since it could not be measured in money, it will not be recognized as accountable transactions that will go to the financial statements that will form part of financial statement information. It should be, the transaction should be affecting the assets, liabilities, and capital, and it should be measurable. Okay? So in accounting, there are a lot of measurements that are here. You will learn that in the future. Like for example, I'll give you some examples. You have face value. Face value is for cash. So whatever is in the face of the cash, that's the valuation in the recording in the accounting. Okay? So if you have 1 billion cash, that's it. 1 million. So there are a lot of valuation which is not at face value. Example, when we talk about investments, sometimes you have to recognize that at fair market value. So in the face of those investments, let's say 10 million, that will not be recognized normally at 10 million. We have to find the fair market value. What's the fair market value? That is the value where Put it simply, if you have to sell those investments, so you're the seller and there is a buyer. So the price that you are willing to sell and the buyer is willing to buy also in that price, that's the fair market value, simply stated. But there is a more technical definition of fair market value in the future. Okay? So there are different values. Aside from the fair market value, we have present value. When we talk about present value, if you will be paid, for example, on at the end of year 5, 5 million, you are not going to recognize 5 million because that is a future value. So there is a mathematical thing that you should do in order to get the present value. So if you have a receivable, for example, of 5 million, you do not recognize it at 5 million. Because again, that is at future value. You have to recognize it at present value. For example, if it is 4.5 million, then after the computation as if, then you have to recognize it at 4.5 million. And there are a lot more. Like we have net realizable value. What is this net realizable value? When we talk about receivables, for example, if you have a receivable from a customer or customers, like for example 1 million, you don't get to assume that this is 100% collectible. You should have an allowance for doubtful accounts. So for example, the allowance for doubtful accounts is 50,000. So what is that 50,000? The allowance for doubtful accounts, your receivables that you are thinking that it might not be collected. Okay? You're thinking that this is doubtful for collection. And if you're going to get 1 million minus 50,000, the difference is what do we call as net realizable value, the 950,000. So there are a lot of these values in accounting, and you will learn that in the future. We also have historical cost minus accumulated depreciation. You will learn that. So historical cost, example, when we talk about equipment, such equipment will not always be brand new. So if you bought it at 1 million, of course, you're going to use that equipment. There will be physical wear and tear, as well as time passage. There will be accumulated depreciation in the future. Like for example, this is 10 years useful life. The useful life of the equipment is 10 years. And that you have used it for 5 years. So that means half of the value will be gone. So that's accumulated depreciation, and that is what do we call as book value. Again, those are just examples. Okay? Now, when we say measurement, those are the things that I am talking to you about. Although, on the measuring aspect also, when you recognize transactions, aside from these values, actually, you are going to measure in the Philippines, for example, the transactions at Philippine peso. And that you're assuming also that the 1 peso today is also the 1 peso in the future or tomorrow. So we do not care if ever the exchange rate changes. Of course, the exchange rate of the peso and the dollar is changing day by day, right? So in here, in the measurement, you have to recognize, if you are in the Philippines, you have to recognize the transactions at peso amounts. And the peso today is the same with the peso tomorrow. So if you bought an equipment of 1 million today, you record it at first 1 million. And a year later, if you bought the same equipment at 1 million also, they are very much the same in the records. You don't actually erase always the peso value. 1 million today, Next year you have to change it because it's not already 1 million because the peso values exchange rate has been changed. You're not going to do that. That is what we call a stable monetary unit concept. I guess that is an old principle, but I guess it's still applicable. Okay? So it will be very tedious if ever you change always your transactions now and tomorrow because there is a different exchange rate. Okay? Now, that's stable monetary unit concept. Okay? And of course, the communicating aspect is in here. The communicating of information. Okay? Now, let's go to the third accounting definition. The third accounting definition is actually from American Institute of Certified Public Accountants, wherein this is an art of recording, classifying, summarizing of transactions in a significant manner and in terms of money, transactions, and events, and interpreting. So those are the key terms here. So let me have this one by one. So actually, this definition plays well with this process of the American Accounting Association. Like, if you're talking about the first steps in making the financial statements and financial statement information, it usually starts with identifying. Okay? And you have to identify the business transactions as accountable or not. And again, let me repeat, you're going to identify that as accountable transactions if they affect the elements of the accounting equation and they are measurable. Okay? So, after identifying and measuring, actually, you will now have to record those accountable transactions known as journal entries, and you will know that in the future. So you just have to remember that's recording. And then those transactions, after they have been recorded, you have to classify them. Okay? To classify or group the similar transactions. For example, if we're talking about expenses, you have to group the similar expenses. For example, salaries. So if you're giving your employee salaries every 15 days, of course, you have to summarize those salaries expenses for the whole year so that you can get the total salaries expense. So it's as simple as that first. You just have to put in your mind, you have to group the similar transactions in the classifying stage. Okay? And there is a technical term for this in the future, but now you have to put in your brain, put in your mind. This is just the grouping of the similar transactions. And when we talk about summarizing, this is the making of the financial statements. Because when you are done summarizing or classifying the similar transactions, of course, financial statements will follow. Okay? And in these financial statements, this is just a bunch of account titles, like for example, cash, 1 million. Account titles, cash, receivables, inventory, something like that. And then the amounts. So those are the financial statements. You have to extract information from these financial statements, which is why we have interpreting. Okay? So you have to get information, sentences, paragraphs of information about the business because of the financial statements or from the financial statements. So in the interpreting, you will see there if ever is the company dying or is it still going concern? Meaning of going concern, not dying, of course. Actually, the literal meaning of going concern is that the life of the business is unlimited. It will not die. Okay? So, going concern. Or else, does it need investments, additional investments, or anything? So that's getting information from the financial statements. Aside from, of course, uh, information like, is the company liquid? Again, being liquid is that the company will be able to discharge its currently maturing obligations. So that's liquidity. We have also solvency, wherein the company is capable of discharging its long-term obligations. So again, interpreting is just extracting information from the financial statements, so that this information will now be communicated to the users of information. So something like that. Okay? So if you're gonna map accounting, it's actually like this. You'll start with the business transaction. It will undergo identifying stage. So what are those transactions that are accountable? So if they are non-accountable, maybe they need to be disclosed, something like that, or not. So if the transaction is not part of the accountable transactions because it does not affect the accounting equation as well as it is not measurable, they are ignored. Okay? But if it is successful, it will become an accountable transaction. They will go to measurement because such transaction should be measured. Because how will you record if ever there is no proper measurement? And then it will go to recording, and then it will go to the grouping or classifying, and then it will go to summarizing or summarizing phase. This time there will be a financial statement already, and then we go to interpreting. So after that, there is already FS information, and then you go to communication. Communication. As long as you can actually understand this communication, and we have users of information, communication to users of information, and we have the final one, the right decision supposedly. Okay? So that is just the whole accounting process. And of course, there are those non-accountable transactions before I end. The examples of non-accountable transactions are the hiring of employees, or else agreement with or the signing of contract between you and your customer, or you or your supplier. Those are the things that are not yet accountable because they do not affect the assets, liabilities, and equity, as well as they're not measurable. But if you wanted to have a very advanced example, your company has been subjected to lawsuit, and in that lawsuit, it cannot be determined first. How much will you lose, or will you lose, something like that. The probability of you losing is not established, as well as the measurability is not yet final, something like that. So they will be considered as non-accountable transactions. They will be ignored, basically, that lawsuit. Okay? And then, there are some times that those lawsuits are disclosed, especially if it is probable already that you will fail or you will lose, but it's not yet measurable. So, the probability is not yet probable. It's already probable, but it's not measurable. It will be disclosed, which is again in the identifying. There are those accountable. There are those that should only be disclosed. There are those that should be ignored. So those are the examples. Okay? And also, we have the last definition. We have already three. The fourth one is the simplest one. Accounting is the language of business. And since business is intangible, it could not communicate its needs to the users of information. Is it dying? Something like that. It could not communicate. The language that could be understood, or what do we call that? The connector between the users of information and the business is the accounting only. It's the language of business. Okay? So, as if the accountants are interpreters of the business so that um, the users will be able to understand what's going on with that business. We are the interpreters. Okay? So, that's the first episode. And you will see that really accounting is just a process of having data which is from business transactions, and that business transactions are formed into financial statements and information that is needed by the users of information for making informed judgments and decisions. Okay, so thank you for watching and see you on the next video. Thank you.